Hello friends, welcome to Pro Trading Zone. So today we are going to discuss about what are the chart patterns that happened in the last week, that is from 22nd till 28th. That was the last expiry session week for the April session. And we are going to look at the candlestick analysis, which will give you an understanding what exactly happened in the market and why it was so. It will also make you understand what exactly you should have done. We will talk about zone trading, we will talk about directional trading, we will talk about what are the important pivot points, what are the important rules, what is the time frame that you should have chosen for the analysis, what are the important rules in the trading while you take a directional trade, or what is the number one rule which you have to follow while taking trade in any asset form. That is, even though you take a trade in crypto, even though you take in trade in forex, stock, or in the number one rule that you have to consider while making a trade in any asset form, may it be crypto, forex, stock, anything it would be. This is the number one rule that will help you to take trade and make less loss. Profit is otherwise, but making a less loss, or rather creating a good setup. Once your setup is right, then there are big profits in your way. So let's look into the first important rule of the chart pattern analysis and candlestick analysis. The first and the foremost thing that you have to look is that you do not see what your mind is showing you. You have to only see what market is trying to show you. Just to give you an example, today if market has opened such a big drop and you believe that market would be covering up the gap, but there is no sign that market will be going up. Only thing that you would have said, see, market is going up over here. From here till here the market is steadily going up. It is going to go ballistic and close a day on the day's high, or it is going to give you a good trade to the market top. This is wishful thinking. Market is supreme always. You only look what market is trying to show you. You only look at the chart patterns that market is trying to show you. What's in your mind doesn't matter. It has value approximately zero. The only thing is that matter in the market is what markets candlesticks are showing you and what market trends are showing you. Nothing else. So only look at the chart and take a trade. Don't do wishful thinking. This will save you from so many losses and so many assumptions that is just wrong while taking a trade. Now we are going to look at what is zone trading and pivot point. Why we prefer to do zone trading strategy, and what are the pivot points that helps a zone trader to make good profit in any kind of market or in any direction. That is, if it goes up we still make profit, it goes down we still make profit, if the market is on the extremely sideways we still make good profit. Why is it so? We will look at the pivot points which we have drawn on our bank nifty chart. So you can see these are the long lines that are forming continuously, and there are some lines which are limited like this, which are limited for the intraday or for the 2-3 days. So the lines which are perpetually going through, those are permanent important pivot points for us, which is derived by us depending upon the price action chart pattern forming and important candlestick formations over there. By that analysis we have determined what is the important pivot point, and it has helped us enormously to take good trades. And whenever this point comes you will find there are some price action, either there is a consolidation or there is a shoot up of the market, shoot down of the market, and you will always find there is some price action that will make you understand what you should do in the trade. Now we will look at the zone trading. Zone trading is an amazing strategy where you make money even though you haven't taken any analysis of market in weekly, monthly, or even on the days level. The only thing that matters for you is the days, what has happened on that day and what are the levels that are available on that day. So here we are going to take up an example of option expiry of 20th April 2022. Here you could see market has just opened little bit up and came down, and it started going down and then started shooting up. This was totally a V-shaped recovery or a right recovery, you could say, you can say any kind of pattern. You can always say that I would have taken trade over here and exited over here and made at least say 450 points in the way. But as soon as you would have taken trade, you could see there is a down, and again this is a chart pattern forming over here. So in zone trading, what we do is that we do not look into the any actions that is happening in the market until and unless it is within the zone. So to give you an example of the option expiry, we took a trade over here and we believe that market would be between the range 36,273 and this pivot point 35,941. Between these two pivot point, we believe that market would be working around. And if it goes out of that range, what we will do is, if it would have gone out of this range, we would have cut our put short position and let our call short position run. As we have taken short straddle and short strangle position, we can put these two strategy over here. If market has breached this important pivot point, we would have cut our call put short position and let our call short position run for profit. Same for here. If market would have breached on the upper side like it has breached over here, we would cut our call short position and let our put short position run in profit. One caveat over here you have to follow always is that if market would have opened over here and candle would have formed here, you would have exited your call short put short position over here, but your call short position is open. You would be making good profit over here. But as soon as it started going up again, you should have cut your position immediately over here. Or if you would have been adventurous, you would have cut your call short position over here. This is because once it starts going up from the point that where you have exited, it will start showing you loss, or rather you would be incurring loss in your profit that you have already made. So you exit your trade over here. So in this way, if market is on the sideways, as we have taken short straddle and strangle, we would be gaining theta decay. If market is going up, we would be cutting our call short position and running our put short position, and we would be making money. If market was going down, we would have cut our put short position over here and let our call short position to run in profit. So in this way, every possibility in the market that could be there is encompassed, and you could make good money with strict following of zone trading rule. So today we are going to look at the chart pattern from 22nd to 28th. That was the last week of the trading session of April, and then we are going to look at what trades we took on that day as a zone trader and what was our profit on that day. So on 22nd, I will explain the zone trading as well as I will explain you the directional trader view that you should have kept. On 22nd, you can see there was a 400 points drop in the market and it started going down. This was the big move for the market, but later market started going only on the sideways, so you wouldn't have been able to take a directional trade and make good money out of it. Even though you would have done a short position if market was going on up, that is put short, you wouldn't have made money because on that day there was no theta decay at all till 3:30. There was no theta decay. The only money that we made was we cut our put short position approximately over here and let our call short position run up till here to make profit as a delta movement. Even though there was no theta decay, we still made money in zone trading. But for a directional trader who wants to follow a zone trading pattern or strategy, for him he has to consider two pivot points that was important. First, this was an important pivot point, that is this part, and this was an important pivot point considered that day. So if market would have gone on either of the side outside, or it would have taken a reversal from here, he would have activated a zone trading directional trade. But as there was nothing like that, the only trade a directional trader should have taken was once market exited the zone over here, he could have taken a buy of put for next week, or should have shorted call short, should have done call short, of the next week, as it was option expiry and much of the time has already passed, it was already 2, he should have taken a call short position and waited till the day's end to make money on it. This was the only trade, and it was initiated because our important pivot point was breached, and it gave you an understanding that market is going down right now. I do not consider any of this chart pattern. This was purposefully drawn by me just to show that you are looking at the downward wedge and you would believe that market would go up. In downward wedge, when market is showing you a downward wedge and you can see the market is on the sideways, you believe that market will go up. Or if continuously market is on the sideways and you see a downward wedge, you see that market can go up. This is the high probability of where the market goes, but it went down. But because of the zone trading rule, we only took trade over here when it was reaching our important pivot point. Any reversal between here, which was a false breakout over here, would have been negated and you wouldn't have made any loss because of the trend reversal or the fake breakout. You only made profit after you entered over here and exited. There was no trend reversal over here. So this was for 22nd. Now let's move for 25th, that is the Monday. On Monday you can see that market has opened extremely low, that is over here, and it started going down and later recover on the same candle to a certain level. One thing that we consider while taking a trade is that the first candle of 3 minute and the second candle has a certain relationship between them. If the 50% of the first candle is not breached and the second candle doesn't exit above the first candle, we consider that day as a trending upward day or sideways day, but the probability of market going is considered to be low, but we consider it to be upward or sideways day. So it initiated my mindset that market could go on the upside. Consider this to be a low probability setup, but you could have an assumption of the direction of the market. So we took a trade that day over here and we considered few of the important pivot points, and important pivot points that was 36,273, 36,106, 35,971, 35,941, 35,808 and 35,360, 35,687, 35,578, 35,578, 35,299. So this was the important pivot point for us as a zone trader that day. But we took 2 trades that day. As we took first trade over here, immediately market started trending and we have taken up a pivot point over here which was yesterday's close, as these 2 pivot points were extremely close and wouldn't have made much sense as a pivot point for us. So we took a trade over here. That was, we exited our call short position over here as soon as it breached our important pivot point and let our put short position make profit over here. Up till here we made profit and we exited the trade with a good profit over here. Later we took a trade here and we waited till here, but we saw no theta decay on Monday itself and we exited here with a little bit of loss because the India VIX has increased. So on the first trade we made good money, on the second trade we made a small loss. But for the directional side trader, you could have considered many chart forms, but I wouldn't suggest any of those were really good one. The first chart form that you would have considered was this retracement. If you consider this pivot point, you can see how properly it has considered this level as important, that is 35,971, and came down, then again started going up and again rested on this point. A big candle was formed from again 35,971. This is the importance of the pivot points, which makes sense to you in the market when it is running. In a closed market where candles has already formed, it is no use for you to say that I would have taken trade over here and exited over here. The chart pattern and the pivot points tells you exactly where to take a trade and exit the trade. So you could have taken this as a retracement trade. Only initiate your trade of either buying a call or setting up a put short position to make profit. And once it started coming down again, you would have exited over here as a directional trader. For a non-directional zone trader, we would have exited over here as there was a red candle forming. So you would have made good money up till here. Or if you would have been more prominent, you would have taken up your profits here itself. If you wouldn't have been greedy, you would have made money up till there also. Later, throughout the day, you saw once you took a trade, it is not a necessity that you should take every trade. If you would have considered this triangle pattern and this as an important pivot point, you would have not gotten any good directional move over there. So when again this pattern was breached, it came back up again, and later when it took a reversal over here, this trade would have given you a profit of approximately 100 to 70 points over here. When it came back up, you would have exited over here. Later when it came here, you would have initiated your trade to go up because of this retracement. Not necessary every time there is a retracement, but it is a high probability setup. When you see there is a retracement in the market, you would have taken a trade over here till the day's high over here. As this pivot point would have breached, I would have exited if I was a directional trader that day and booked my profit. I wouldn't have considered this trade because it wasn't giving me a proper understanding what exactly is happening. So later on that day, I wouldn't have considered any of the trade. Here you could see one of the chart patterns. If you had to consider a chart pattern, this could have been one. Over here you would have said this is a reverse head and shoulder pattern that has given you a profit till up till here, but it is not a proper chart pattern. You do not draw chart patterns with you think is true. You only draw chart patterns or consider a high probability trade which market shows you that it is a good chart pattern. So I wouldn't have considered this to be a high probability trade. This was for the 25th. Now just look at the 26th and how good that day was for a zone trader. So on 26 market has been pretty much on the sideways. The only moment you can see is over here. 26 you can see that market was pretty much sideways and there was not much that you can see in the market in terms of the patterns that were forming in the market. This was a deliberate attempt of mine to see what market was doing or what I can draw, but this is not a high probability setup. The reason for it is that there is no proper angle that is showing you that it will go up. There is no proper setup telling you it will go down. This is not a high probability setup for as a chart pattern drawing. For us, we have taken up a trade over here. So the pivot points for us for that day was 36,943, 36,875, 36,658, 36,411, 36,273, 36,106. For a zone trader, this was an important pivot point. Once we took a trade over here, the only thing you had to do for that day was sit until here. You would have earned a theta decay, as well as when market breached our important pivot point, that is the zone. This was the zone that has formed for that day, and as soon as it breached, you would have exited your put short position and run your position up till here, or up till here you would have made good money as it would have been a directional trade. You would have had theta gain over here, as well as once it market exited you would have the delta gain over here. So theta and delta both supported you in this trade. Later on the day we wouldn't have taken any trade because we have made our profit for the day properly. The chart pattern for a directional trader would have been this retracement which was coming up again. So market a directional trader would have entered here, would have gone up till here. Once 2-3 candle was in red, he would have exited over here itself to book profit of approximately 100 points properly. But if you would have been more adventurous, you would have considered this as a channel. We generally take horizontal line as a more prominent one than this kind of trend. So we would have considered this as a channel, and it broke, it went sideways, and then it started coming down. So it was an upward wedge which generally give you downward direction. As market came from up down, it went into a wedge, then it started coming down. This is a typical chart pattern that happens in the market, and this could have been good one. But for a zone trader, what we would have considered is that we wouldn't have considered this wedge. We would have only considered as a channel for us where we haven't taken any non-directional trade, only this as a channel for directional trading. And once this was breached, we would have waited for one important pivot point for us to breach again as a retracement. Then we would have taken a trade for downside till here. You could have exited over here as it would have yield you approximately 120 points to 150 points over here. So this was a very high probability trade, and a zone trader should take only this kind of a trade. There is no necessity to draw like this and consider that market should be going down. You would have lost our psychological war over here as market was going sideways, and you would have seen a green candle going over here because you can see a wick formation over here. As soon as you would have gone long, you could see the second candle coming down straight forward to make a loss for you and hitting your stop loss. So this is how you avoid fake breakout and avoid to take a trade where there is no high probability trade happening. This is for 26. Now let's move for 27. So on 27 you can see that market has been on the sideways on the start of the day till 11:30. This point would have been really impatient for the amateur traders who wouldn't have much trade in their mind. But for a zone trader, what we would have done is just put this was an idealistic condition for us that it is wrapping around our important point of 36,106. We took a trade over here as a zone trader, and the important pivot point for us again for that day, which was perpetual, those were 36,658, 36,411, 36,273, 36,106, 35,971, 35,411, 35,808, 35,687, 35,578. So these were the important pivot point we consider for the day when we put up our strategy over here. So if market would have breached here, we would have exited our call short position and let our put short position over here, as we have put in our short straddle and short strangle over here. So on 27th we wouldn't have taken any irrational trade over here, as we would have taken our trade over here and sat through the day to make good money. But for a directional trader it would have been really impatient for them, and it would have taken any trade and just exited from the market by the theta decay he would be seeing in the market, even though market didn't went anywhere. The important pivot for the day was 36,411, 36,273, 36,106, 35,971, 36,941, 35,808, 35,687. So these were the important pivot point. But as soon as we took a trade over here, the important pivot point for us was 36,273, and below it was over here. This was the important pivot point. If market would go out of this zone, we would take a directional trade. So once we waited for so long, we had good theta decay in our hand, that is we're making good profit up till here. And once it exited here, we would have considered either to cut our position over here, just as we were making good profit. Let's say if we were making more than 0.7%, I would have just exited my market positions over here totally. But if I would have been adventurous, I would have exited my put short position over here and let it run up till here to breach one more pivot point, and as soon as it took a reversal, I would have exited my call short position also and exited all my trade from the market and made good money in the process. So even delta and theta would have helped me to make good money on that day. Now let's look at the chart patterns that has formed over here. So once it came over here, that was our important pivot point, this was our important pivot point, it took a reversal on the upside and later it went again on the side. But once there was a big candle formation over here and it exited, we would have taken a position over here, that is we would have taken a call short position or bought some put and waited till this pivot point was breached. it would have given you approximately 150 points of directional move to you, and you would have made good money into it. Once again, when there was a reversal and the market came over here, and again there was a retracement over here, you would have initiated your trade here, or being impatient you could have taken up trade over here, and again till here we would have clearly made good money. That was approximately 130 to 140 points, and market would have given you a sideways. I wouldn't have considered this to be very high probability, but you could have considered this, again this, again this, as a trade to take up, but it was within the zone. So I generally avoid taking a trade within the zone. When it is outside the zone, I am happy to take a trade. And as day was coming to an end, I wouldn't have taken trade after 3 o'clock over here, 3 o'clock over here, but within the zone I generally avoid taking a trade. Now let's look at what happened on the option expiry and how much money we made into it, and what was our view as a zone trader and as a directional trader. Where should you have taken a trade using zone trading rules, and how good it became. So as a zone trader, we saw that market didn't open any much up or down, rather a sideways opening or equal opening. As soon as market opened up, it came down and market was steadily going on the downside. But as soon as it came to our pivot point of 36,106, I took a position over here of short straddle and short strangle and considered these two as an important pivot point. Between these two important pivot point, I didn't take any other trades. So I took a position over here. Even though I saw a big fall in the market, I didn't take any trade. I let it be as it is. I would have only taken a trade once it would have breached over here properly. This was a very short movement over here. Market came down and just went up within 1 or 2 seconds. So there was no point of taking trade over here. I would have exited my put short position, let my call short position if market had come down over here. But there was no need, as the market has given respect to our 35,941, and later it started going up again. Here you could say that market is going up, I would have earned good within the zone, but for me this was a low probability trade. I wouldn't have taken a trade for the upper side in within the zone, because the probability of it going in a very small pattern is high. But still, if you would have been adventurous, or you would have to take a trade, what you can say is that you can take a trade over here when it took a retest over here, or rather it took a retest over here then started going up. This could be a trade for you, but not for a zone trader. For us, we took a trade over here and exited over here. We made good profit out of it, and we were happy to do a zone trading because it didn't give any pressure on me to analyze the market when it is within the zone. And we don't have to look at what the candlesticks are happening within the zone, what are the chart patterns happening within the zone. We are free of this tension. The only thing we do is that once the market is exiting the zone, we are taking up a trade. So we made good money over here. The trade that I would have suggested is that market breached, it went up, again came down, and again it started moving up. This could have been a good trade which would have yielded you approximately 140 points, 150 points without worries, because it was within the zone. I generally prefer a short position rather than a long position, because when the market goes on the sideways, you would be happy to take a trade, and the stop loss should be according to your appetite. I generally prefer not more than 0.5%, or in numbers or in points wise, it shouldn't be more than 40 to 60 points of the stop loss. Even though over here also our stop loss would have been over here at least 40 to 60 points, and it would have taken up this retracement or this false candle coming down like a pro, and market would have given you a good profit. As you know, after 3 o'clock I generally do not take any directional trade, or do not prefer to take any trades into it, or if any trade is active in my account, I let it be. But still I would have avoided any of the trades over here, as a zone trader and wouldn't have taken any trade, and just be happy with the profit I have made by just sitting in the market by doing no trades between these 2 points. So that's it for the day. If you liked my analysis, if you had much problem by understanding what I mean by zone trading and again with directional trading, zone trading and directional trading, I would recommend you to follow my live shorts that I put in every day in live trading session. It will give you an understanding when market is moving where I am putting my trade. You could actually see when I'm putting this trade over here, you could see that there is no candle formation over here, and I have put in that trade immediately in my YouTube shorts, and you could see what are my important pivot points, what is my market view, and what is the adjustments I am taking over there. But before taking any trades, please do your own research, take a deep action towards learning, gathering knowledge, then only take a trade. I would strongly suggest that. If you like my analysis, please subscribe, share with a friend, come like some videos. It helps with the YouTube algorithm. It would be nice to see you in the live trading session. If you have any queries, put in comments that would be reviewed by me, and if possible answered in the next video or immediately in the same comments reply. So that's it for the day. Please like, share, subscribe. Thank you.